welcome to Investment Made Easy, your front row seat to smarter investing, brought to you by Outlook Money, India's most trusted personal finance magazine. In this show, we break down investment trends, decode new products, and help you make confident money decisions. This episode of Investment Made Easy is in association with ICICI Prudential Mutual Fund. I'm your host Ankita Verma, and today we are decoding a new investment strategy that's getting a lot of attention through the lens of ICICI Prudential Nifty Top 15 Equal Weight Index Fund. Should this equal weight approach be your next smart move, or is it just another buzzword? Let's break it down with guidance that cuts through the noise, and to walk us through it, we have Chintan Haria, Principal Investment Strategist at ICICI Prudential AMC. Chintan, welcome to the show.
Hi, Ankita, and a very, very warm welcome to all the listeners of Outlook Money as well. Thank you so much.
Okay, let's start with the basics. My first question to you is, what exactly is the ICICI Prudential Nifty Top 15 Equal Weight Index Fund, and why is it in the spotlight right now?
So, Ankita, over the last 6 to 7 years, it's been our endeavor to present investors with an opportunity to invest in markets through a variety of products on the passive side. Passive investing is picking up with investors understanding more on what is index funds, and as a result of which the offerings have also increased. So typically in the last few years, we've seen increase in the investor interest. The earlier products which were available were market cap based. So you had the 50, top 50 large cap, top 50 mid cap, top 50 small cap. The weightages of these stocks were chosen on the basis of the market cap. So the largest market cap will have a higher weight, and so on and so forth. If we look forward in terms of the sectoral diversification, then banking, IT became popular in terms of index funds. Then the smart beta products like low volatility, momentum, value, quality are becoming popular. In that same context, there is a growing trend of investors wanting to participate in a narrower set of Nifty stocks, a narrower set of stocks in large cap, but where the weightages are equal, and that's where the prevalence of the ICICI Prudential Nifty Top 15 Equal Weight Index Fund in the investor's portfolio. The fund, as we speak, is an index fund which is tracking the 15 stocks, which are selected on the basis of the largest free float in the past 6 months. And if we look at those stocks, their weightages are equal weight every 6 months when the rebalance happens. So typically in a index fund where the weightages are on the basis of market cap, in this case, as the name suggests, the 15 stocks, which are the large stocks or the largest stocks in India by free float market cap, have been given an equal weight so as to represent truly the wide variety of the top 15 sectors or segments within those top 15 stocks which are there in the market. Thank you.
The Nifty 15 Equal Weight Index different from other indices like BSE, Sensex and Nifty 50?
Yes, so like I was explaining, if you see the 50 stock index or the 30 stock index, they'll have 50 stocks, and those 50 stocks will be weighted on the basis of weightages of each stock would be on the basis of the free float market cap. So the largest free float market cap will have a higher weight, and so on and so forth. There'll be 50 stocks and there'll be 30 stocks. In this case, these 15 stocks will have equal weight. So if you divide 100 by 15, you'll get roughly 6.66% or so, odd. So at the time of rebalancing, all these 15 stocks will have a weight of 6.66% roughly in the index, and not the weight which they would have had it been based on, let's say, the market cap. So for example, the largest weight in, say, the 50 stock portfolio, because it is free float weight portfolio, would be, say, 13 or 14%, because the largest weight is the largest stock and it is significantly large. The next weight would be 8 or 9%. In the case of Nifty 15 equal weight, top 15 equal weight, it will be basically 6.66% for each of the stocks. So basically, we are removing the market cap based bias and getting a true representation of those 15 stocks, which are the largest, without having to constrain ourselves with the market cap bias. So market cap bias, if someone wants to go by the market cap, then they are anyways available as index funds since a long period of time. But if you want to have an equal weight representation, meaning you want to participate in those top 15 stocks in a proportion which is equal, and every 6 months they will get equalized in terms of their weights, then the top 15 equal weight fits well in the investor's portfolio. It is giving enough diversification by having 15 stocks, and also by having equal weight, it is getting enough representation of also of those 15 stocks, which sometimes gets missed if the market cap bias is presented in the market cap weighted indices. So both the indices have their own pros and cons in terms of how they function. And so investors who are looking to diversify from the market cap based indices, or who want to look at the equal weight indices, this Nifty 15 top 15 equal weight would fit in well in their portfolio.
So, Chintan, rebalancing is a buzzword that is often overlooked in practice. How often is this fund rebalanced, and why does that matter for long-term investors?
So, as is the case with all index funds or all passive funds, the fund is basically replicating or endeavors to replicate the underlying index, which is the Nifty Top 15 Equal Weight Index. And the index methodology is quite clear. It is a methodology is already in the public domain. It says that every 6 months, the rebalancing happens in a way that the stocks are brought to their equal weight. In other words, for example, between two rebalances, for example, one stock does very well, the other stock probably does not do well. Then you have a stock which becomes overweight, goes above that 6.66% weight, and the other stock would come down below the 6.66% weight roughly. And at the time of rebalance, all the stocks, so the stock which has gone above 6.66 will be brought down to 6.66. So there is a profit booking, so to say, in the stock which has done well. And if a stock has come down below 6.66 because it has underperformed in the last 6 months, it will be brought back to 6.66. So there will be averaging of the portfolio or the stock which has not done well. So at every 6 month period, the rebalancing happens. There can be a stock which moves out and a stock which moves in if certain particulars or requirements of the changes in the constituents are also basically met. There is a buffer mechanism wherein if a particular stock, let's say, has a weight which is more than 1.5 times of the lowest weight in the index, then at the time of rebalancing, that stock would come in. And so there is a change in the index constituents also, which is possible. So just two things to simplify for the investors. Every 6 months, the portfolio is rebalanced to its equal weight status. So there is some profit booking in some stocks and some averaging in the others. This mechanism obviously is useful for investors to book profits and average at the lower end of these 15 stocks. And sometimes there may be a change in the stock constituent itself if certain parameters of inclusion and exclusion are met. So these two reasons help the index over a period of time to not just remain a static index, but also be an index which is rebalanced and helps the investors to achieve the goal of participating in the markets and yielding the returns which investors expect.
That really helps simplify it for our viewers. So, Chintan, what's the sector spread like? Are investors really getting diversification, or do a few sectors dominate?
So, since the stocks are 15, if we look at the largest names in India, it is a good diversification of large representative sectors. Some of the sectors, because they don't form part of the top 15 names, do get missed out. So if we look at typically what gets included, we see a good representation of India's top four private sector banks, India's largest public sector bank, India's largest finance company, non-banking finance company. So you have a good representation within financial services. If we look at engineering, also India's largest engineering companies included. There is consumer names, both of India's consumer names, which are the largest, are represented in the index. So you have a tinge of FMCG also included. Autos, the two of the largest auto companies in India are also included. So one must pay attention to the fact that if you narrow it down to top 10 stocks, then sometimes you may end up missing, let's say, autos as a segment, right? Because they form beyond the top 10. While in the top 15, autos as a segment gets included, which is a good thing. Then there are others also. India's largest oil and gas company, of course, comes into picture. So there's a good representation of the larger sectors in India, which are the growth engines as far as India is concerned. So typically your engineering, oil and gas, FMCG, that is getting included. If we look at even telecom, India's largest telecom company is also getting included. So there is a good representation across these sectors. The major sector which arguably gets missed out because it is not part of the top 15 is pharmaceutical. So there is no pharmaceutical name which is large enough and participating in the top 15. So that one segment of pharmaceuticals, apart from that metals, that gets missed out. So there are a few sectors which don't form part of the top 15, but what forms part of the top 15 is a very good representation across banking, oil and gas, telecom, FMCG, and auto, and which are the driving forces as far as India is concerned because they are more consumer facing. Thank you so much.
So, with just 15 stocks, some may worry about concentration risk from an investor point of view. Is that concern justified? And how should the investors weigh potential risk versus the reward here?
Yes, if you look at 15 stocks, typically that is a concentrated universe. But because the division is on the basis of equal weight, you're getting equal weighted 15 stocks. So there is a diversification within the concentration, which is as far as the number of stocks is concerned. So while the number of stocks may be concentrated, there is a diversification of sectors, there's a diversification of weightage, which is the good part. Now, from a liquidity and investability perspective, plus the risk perspective, since these are largest Indian stocks, they are large cap, the liquidity is strong, and the replicability as far as the index is concerned is not a challenge. So from a functional aspect, yes, top 15 is concentrated, but the reason why it is concentrated is you're getting an exposure to the top 15 names, and the diversification is taken care of by the weightages being equal weight. So I think it's a good mix of someone who is looking at concentrated 15 stocks to in their portfolio, but having the diversification of weightage. And so from a risk reward perspective, if you look at it, from a return perspective also, if you look at it, from a valuation perspective also, if you look at it, it is not too inferior, or it is at par with the market cap based indices. And the good part is in this, you're getting basically a select set of 15 stocks, which typically in a drawdown end up doing better because these are large balance sheets, which end up basically having a stronger mode. So in times when markets are uncertain, this portfolio will help. So this is part of the portfolio where investors make it a core long-term investment where the overall portfolio strength improves meaningfully by having these 15 stocks. So I wouldn't worry too much about the fact that it is only a 15 stock portfolio because these are 15 of the largest names in India where the concentration risk is being taken care of by the diversification of the weightage. And so from an investor standpoint, this adds to their overall portfolio strength as they keep adding this particular Nifty top 15 equal weight index fund in their portfolio. And these are companies which arguably in the next 5 years, 10 years, 15 years should keep getting stronger and bigger. And let's remember again what we discussed about rebalancing. Should one or two companies within this falter or move out, or should some other companies do better, then there is always a chance that you end up having those companies in the portfolio of top 15. So the rebalance mechanism ensures that the investor, without having to do anything themselves, are getting a true representation of the top 15 largest companies in India over a period of time. So this is not a tactical investment, it's a core investment for the long run. And investors have to wait patiently for this to basically add value to their portfolio. So it's a long-term investment, it's a patient investment, and that's what basically investors should keep in mind.
I think that's very reassuring for the investors. Okay, let's talk returns. Our audience would be very keen to know how has the Nifty Top 15 Equal Weight Index Fund performed versus the Nifty 50 or the Nifty 50 Equal Weight Index? Are there any surprises in the data?
So I think if you look at the data, and if which is there in the presentation as well of the index, do you have a scenario of 1 year, 3 year, 5 year, and 15-year outperformance as far as Nifty's equal weight is concerned, Nifty 15 equal weight is concerned versus the broader market index? But I wouldn't want to compare the indices. What I would want investors to do is to see how this fits standalone in their portfolio, and does it meet their portfolio long term. Because in India, we are still not at a stage where investors are looking at a particular product versus another particular product. Investors are today genuinely looking at diversifying from their traditional investment methods, typically where fixed income used to be a very large part. So we've seen gradually investors move from fixed income to equities, within equities from active to passive, and active and passive both in their portfolio. So it's just a question of having sensible investment time horizons and entry points into these particular products. So I wouldn't compare one with the other from a performance point of view. I would rather say from an asset allocation point of view, all of these fit well. Treat them as your equity portfolio because these are pure equity products. They will carry equity risk. But in this instant, for example, the Nifty top 15 equal weight, these are the largest balance sheets in India, supposed to be the most resilient companies in India, the most well-run companies in India, and hence this adds a lot of strength to your portfolio over a long period of time. And that's how I would look at it without wanting to compare the returns, because returns are in the past. They may vary from time to time. What matters from an investor standpoint is the entry point when you enter, how you enter. I mean, you can do SIPs also in the index fund. It is a great way to accumulate over a period of time. And more importantly, to hold it patiently. So the two key elements are how you are going to buy the units and how long you are going to hold them, rather than trying to compare it with other equity products, because your return experience over a longer term period will be determined more by these two aspects rather than by comparing it with the other products. And almost all the products in equities in India, if sensibly invested and held for long run, will achieve a return which investors would probably say beat inflation. But your entry point and your holding period are the two key variables, which is in the control of investors. This portfolio by itself is going to do what it does, and it is a strong portfolio of India's largest 15 names. But for investors to get the true flavor and the true return experience in their portfolio, the entry point and the holding point, as far as any investment in their overall portfolio, is going to be of extreme importance. So I wouldn't compare. I'd rather say focus on your entry point and your holding point. Thank you.
I would like to dig a little deeper into this. So, not every fund fits every portfolio, right? So, who is this fund really suited for? Any specific investor profile or goals it matches well with?
So if we look at, say, typically the broad market indices or even the Nifty top 15 equal weight, these are core portfolios which every investor must have. From a long-term perspective, if an investor wants to get, let's say, a very stable set of these top 15 largest names in India in an equal weight basis, then you basically are ensuring that you are having the right representation of the top 15 names. It's not market cap weighted, so you don't end up having the largest market weight in a disproportionate places. So it's essentially betting on the top 15 names or investing in the top 15 names in an equal weight, which I believe will fit in every investor's portfolio. So all investors who have equities in their overall portfolio and have a very good, let's say, balance of their overall equity portfolio, where they have within active funds, they'll have dynamic asset allocation, within passive funds, they'll have core portfolio of market cap based indices, and then they'll have smart beta indices. So as part of the smart beta indices, the core portfolio should have this Nifty top 15 equal weight across all investors, be it a large investor, be it a new investor, be it an investor who's just starting their journey. The good part is, since these are the largest 15 names, well-known names, good balance sheet, strong business, strong brand recall, these can add to all investors' portfolio depending on how they have constructed their portfolio. Because even the investor who has the highest risk appetite will have a certain portion of large cap in their portfolio. An investor with the lowest risk appetite will have a certain portion of large cap in their portfolio. And within that, they can definitely fit in the Nifty top 15 equal weight as a core part of that particular portion of the portfolio. So this will suit every investor's portfolio, more so from a conservative to new investors portfolio who are starting their journey. This will be more relevant. Thank you.
I think that's very valuable perspective to keep in mind. So my final question to you is, what's your guidance on how much to allocate to this fund? Any rules of thumb or mistakes to avoid?
So typically investors should keep in mind that this being a this being a top large cap name fund. And overall, if I have to look at it, and generally that's how one should construct the portfolio. depending on your risk appetite, of course, you will have a certain portion of dynamic asset allocation in your portfolio, right? So that should take care of your equity debt requirements. Multi-asset should take care of your equity debt commodity requirements. So that should be about 40% of your portfolio, 40 to 50%. 25% would be within active flexi cap, mid cap, small cap, as the case may be. The balance 25 which you have in passives, out of that 25% which is you have in passives, you should probably look at having a 5% weight within the Nifty top 15 equal weight portfolio. So I think a 5% weight is a good weight to go by as far as an investor is concerned. And more importantly, the overall asset allocation, as I mentioned. So within the overall asset allocation, 40 to 50% in dynamic asset allocation or multi-asset allocation, which is on the active side, 25% on the active side, which is flexi cap, mid cap, large cap value, special situations, as the case may be. And the 25% which is dedicated to passives, which most investors these days are trying to dedicate to passives. Out of that 5%, meaning 5% of the overall 100% that they have in equities, can be into this fund, and the rest 20% can be on the other passive funds which are available. So I think 5% is a good way to start with. And if an investor is conservative or new, they can definitely have even a 10% weight in this fund to start with. That's not a problem. But 5% is a good way to have in the overall portfolio construct. Thank you.
That's incredibly helpful, especially for anybody trying to build a smarter portfolio. Thank you, Chintan, for that insightful and detailed discussion. You've helped our listeners understand not just the Nifty Top 15 Equal Weight Index, but also how it fits into a broader investment strategy with a balanced and diversified approach. So that brings us to the end of this episode of Investment Made Easy. Stay tuned for more conversations that simplify the world of personal finance. Don't forget to like, share, and subscribe. And if you have any questions, feedback, or suggestions, do write to us at letters@outlookmoney.com. Thank you for listening. And as always, invest smart and stay curious.